Welcome to Breaking News to Trading Moves. We're looking at a headline today coming out of the aviation world, and stick with me here, it's not really about planes, it's more about the machinery of the stock market itself. The headline involves AirAsia founder Tony Fernandes. He's announced that the group's AirAsia brand management unit is closing in on a Nasdaq-listed target to complete a backdoor listing.
It's a classic financial maneuver. And you're right, while the company involved flies planes, the story here is really about deal structures and, market appetite. When we see a headline like this, an Asian aviation brand targeting a U.S. listing via backdoor route, it sends a very specific set of signals to the market.
Before we get into the winners and losers, we should probably clarify what we're actually looking at. The term backdoor listing sounds a bit illicit.
Yeah. Like someone sneaking into a club.
Exactly.
It's much less dramatic than that, though it is certainly a shortcut. A backdoor listing, often done through a reverse merger, is just an alternative way for a private company to become public.
So instead of a traditional IPO.
Right. Instead of doing all the heavy lifting of an initial public offering, the road shows, building a book of investors, all that regulatory scrutiny, the private company just merges with a company that's already listed.
So they find a shell that's already on the exchange and just inhabit it.
That's the perfect analogy, like a hermit crab finding a new home.
Right.
You find a publicly traded entity that, often has no real operations, and you merge your private business into it. The private business takes over the listing. It's faster and often cheaper.
And the reason the market cares about this specific news with AirAsia is that it signals clarity.
Exactly. When a founder says they are closing in on a target, it tells investors that the deal structure, the timeline, it's all firming up. And that clarity has the potential to re-rate stocks in three very specific areas.
Yeah.
We're talking new listings on the Nasdaq, M&A advisory activity, and investor appetite for a specific type of business model, the asset-light royalty-style brand.
It creates a chain reaction. One deal signals confidence, and suddenly everyone is looking at who else benefits. So let's move to the winners. Who stands to gain the most from this?
Okay, so the first category of winners is, I'd say, the U.S. listing ecosystem itself.
The ecosystem. You mean the venue where the trading happens.
Exactly. If this deal goes through, it's a win for the Nasdaq. More Nasdaq-bound transactions can lift overall exchange listing activity. It's a volume game.
And every company that lists there pays fees.
They pay fees, they add to the data they sell, and it boosts the prestige of the venue. So the first ticker to watch here is the exchange itself.
That would be Nasdaq, ticker NDAQ.
Correct. But let's look a layer deeper. It's not just about the listing fee. It's about the branding of the exchange. Nasdaq wants to be seen as the home for innovative, international, growth-oriented companies. Securing a high-profile Asian brand like AirAsia just reinforces that narrative.
So NDAQ is the venue play. But these deals don't just happen by themselves. You mentioned closing in on a target. That implies a lot of work.
It does. These are complex deals. A reverse merger is often accompanied by a PIPE. That's a private investment in public equity.
Okay, hold on. What's a PIPE in this context?
Right. Good question. Think of it this way. The shell company, the hermit crab shell, it might be empty. It might not have enough cash to fund the growth that AirAsia wants.
So it's just a listing, no money.
Potentially. So before they close the merger, the bankers go out to big institutional investors and say, we're merging AirAsia into this shell. Do you want to buy a chunk of stock right now at a set price to give the new company a cash war chest?
So it's a private fundraising round that happens at the same time as the public listing.
Precisely. And structuring that is not easy. You need bankers to structure the financing, advisors to manage the execution.
Which means the big banks get a slice of the pie.
They always do. The advisory and financing fees for these types of deals are a major revenue stream. So when we see deal flow picking up, especially these complex cross-border deals, we look at the big players.
Goldman Sachs and Morgan Stanley.
You got it. Goldman Sachs, ticker GS, and Morgan Stanley, ticker MS. They're the names to keep in mind here.
Makes sense. If the backdoor road is becoming popular, GS and MS are the ones holding the keys.
They're the ones facilitating the entry.
Okay, let's pivot to the second group of winners. This one's a bit more abstract, but it really touches on business strategy. You called it asset-light consumer models.
Right, and this is where we have to look at what AirAsia is actually listing. They are not listing the heavy metal, the planes, the fuel costs. They're listing the brand management unit. This is an intellectual property play.
So they're selling the brand, not the seat on the plane.
In a way, yes. They're monetizing the brand itself. The airline business is notoriously difficult. It's a low-margin grind. But owning the brand, that's high margin.
You just collect the royalty check.
Exactly. And when a high-profile narrative like this hits the market, a story about listing a brand to make money from licensing, it creates what we call investor attention spillover.
Spillover, meaning investors start looking for other companies that do the exact same thing.
You got it. It reminds the market how powerful the franchise and royalty model is. You own the brand, someone else operates the assets, and you collect a check.
And the kings of that model are usually in fast food.
They are. McDonald's is the prime example. Most people think McDonald's sells burgers. They don't. They're a real estate and brand licensing company. Their ticker is MCD.
Because the franchisees own the equipment, pay the staff. McDonald's corporate just owns the land and the logo.
And they take a percentage of revenue. It's an incredibly resilient model. So if AirAsia is telling the market, we're unlocking value by separating our brand from our planes, the market looks at MCD and nods.
And I assume the same logic applies to Yum brands.
Yes. Ticker YUM. They own KFC, Taco Bell, Pizza Hut. They monetize brands via franchising. If the market gets excited about AirAsia doing this, that enthusiasm can bleed over into MCD and YUM.
It's a reminder that owning the logo is sometimes better than owning the store.
Much better, usually.
Okay, the third winner category takes us back to travel. Because at the end of the day, AirAsia does need people to fly.
Right. We have to look at what AirAsia represents. It's a massive player in Asian travel. If they're confident enough to push for U.S. listing now, the market might read that as a vote of confidence in travel momentum.
So even if I'm not buying AirAsia stock, I might feel better about travel in general.
That's the logic. It's a sentiment tailwind. If the narrative is travel is booming in Asia, then U.S.-listed platforms that facilitate travel booking could see a lift. It's about the sector vibe.
So we are looking at the big online travel agencies.
Precisely. Booking Holdings, ticker BKNG, and Expedia, ticker EXPE. These are the proxies for online travel demand.
Why do you call them proxies?
Because they're the toll booths. They don't care if you fly AirAsia or Delta. They just care that you're booking a trip. If volume is up, their revenue is up.
So if the water is rising for global travel, these are the boats that float higher.
Exactly. BKNG and EXPE are the aggregators.
Okay, that covers the winners. The Nasdaq and the banks for mechanics, franchise giants for the business model, and travel platforms for the sentiment. But a trade always has two sides. So let's talk about who might be sweating a little bit when they see this news.
The first group in the losers bracket would be the competing listing venues.
The rivals to the Nasdaq.
Yes. The stock exchange business is fiercely competitive. They fight for every single IPO. It's a zero-sum game in many ways. If a deal like this chooses Nasdaq, it's a win for them and a loss for everyone else.
What about market share?
It is. It's a marginal negative for the New York Stock Exchange and others. They lose the listing fee, the trading volume, and the marketing win.
So looking at the tickers, who are we talking about?
We have the Intercontinental Exchange, which owns the NYSE. Their ticker is ICE.
And Cboe Global Markets as well.
Yes, ticker CBOE. They're also fighting for that listing market share. Every deal that goes to a competitor is a missed opportunity.
It's a branding war between the exchanges themselves. Now let's look at the airlines. You mentioned AirAsia is a low-cost carrier. Does this news affect the big U.S. legacy airlines?
It can, but through the competition narrative. AirAsia is famous for its low-cost model. It's ruthless on efficiency. Anything that boosts the profile of that model serves as a reminder that pricing power in the airline industry is incredibly fragile.
Because if the low-cost guys are getting attention and capital, it means the price war is never really over.
That's it, exactly. The airline industry only makes good money when capacity is disciplined. Low-cost carriers exist to disrupt that discipline.
And if AirAsia gets a U.S. listing, they get access to U.S. capital.
Which means more money to buy planes and expand routes. When capacity increases, legacy carriers often suffer. They have higher cost bases. So this can weigh on sentiment for, say, American Airlines, ticker AAL, and United Airlines, ticker UAL.
It's a reminder that their margins are always under attack.
Right. It puts the race to the bottom on ticket prices back in the spotlight.
Okay, the final category of losers is a bit more technical. We talk about how this is a backdoor listing. Who loses when companies choose the backdoor?
The front door intermediaries. There's a whole industry built around the traditional classic IPO path.
So if the backdoor becomes the trendy entrance, the front door guards get lonely.
That's a good way to put it. A traditional IPO is a marketing event. There's hype, a roadshow, a scramble by retail investors to get shares. Brokerages use that to attract customers.
But with a reverse merger, that doesn't really happen.
No, the deal is done behind closed doors with institutional investors. By the time it hits the screen, it's already trading. The pop creates less frenzy for retail brokerages.
So if backdoor routes stay popular, it pressures the parts of the workflow that depend on the traditional process. Which names are we watching there?
Freedom Holding, ticker FRHC, and Interactive Brokers, ticker IBKR. These are firms that benefit from a robust traditional IPO market.
Right. Freedom Holding has built a lot of its business around providing access to U.S. IPOs for international clients.
Exactly. If the inventory of hot new IPOs shrinks because companies are choosing to merge with shells, that's a headwind. And for Interactive Brokers, IBKR, while they're massive, they also benefit from the active trading that comes with the traditional IPO season.
So to wrap this up, this single headline about AirAsia, it's really a story about the Nasdaq winning a battle for listings. It's a story about the asset-light business model getting a gold star. And it's a story about the tension between the new school and the old school.
That's the essence of it. The way companies come to market is changing. And that benefits the flexible players like Nasdaq and the specialized advisors while putting pressure on traditional gatekeepers and legacy competitors.
It really reinforces that you have to look beyond the brand name in the headline. Don't just see AirAsia, see Asset Light, see Nasdaq versus NYSE. That's where the real trading moves are hiding.
Precisely. You want to be positioned where the structural momentum is going, not just where the news of the day is pointing.
And with that, we will leave you to think about which door you'd choose, the front or the back.
A critical question for any market participant.
Just a reminder before we go, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for listening to Breaking News to Trading Moves. We'll catch you next time.